some of the key findings that relates to international market that we have developed in more detail over the last two editions of the Trade and Development Report, this year and last year. So when I refer to international market, in fact, what we have in mind here is mostly the financial flows to developing country, also what has happened in international commodity market, and obviously what's going on with international trade, both for services but also for manufacturing. So from a macroeconomic perspective, we know that obviously national policy are extremely important for development, and I'm sure you are aware, but UNCTAD has several capacity building and other technical cooperation projects. So we go at time to country. We support developing country at the national level. Even though we don't have a permanent presence in most of the developing country, unlike, for instance, UNDP or the resident coordinator office and all that, but we do have very precise expertise in some areas, and there are various programs that UNCTAD actually do to basically work at the national level. Now, for our unit, we are focusing more at the macro level, and so forgive me if sometimes I tend to generalize a little bit and grouping country in broad group, but we still believe that there is some relevance in that type of analysis, and especially when it comes to the international macroeconomic, we know that very often the external environment can also have a very significant effect on the national development pathway. For many small developing economy, this external environment is something that is extremely difficult, or I would say even sometimes impossible to significantly influence, and is it often, as we say in economics, taken as an exogenous, let's say, parameter, at least for which in the short term it's taken as given, and you can hardly influence that. So understanding this external environment, which is unfortunately often not necessarily favorable for development, is something important, and that's the aim of my presentation today. It's to review with you what's going on in those areas. So with this preliminary remarks, let's now delve into this matter. So the structure of my talk today is basically split in three parts. So initially, I will discuss with you and review some of the recent trends in three main areas, as I mentioned before: capital flows to developing country, international commodity market, and international trade. And that basically mostly drawing from this year's TDR, and in particular the Chapter 2. Then I also want to discuss with you some of the long-standing and also emerging trade-related weaknesses that we have observed, and that's something that we develop more in detail in the 2023 TDR, the Chapter 2, if you want to know more about that, and more specifically because I cannot address all the long-standing trade-related issues during my presentation, but I want to focus on two things. The first one basically relates to the evolution of the distribution of the gains from trade, because I think being a policymaker in Geneva, it's something very important. And the second one is also linked to trade, and that's basically to review some of the policy shifts that we have observed and that are currently reshaping and will continue to reshape world trade in the years ahead. And finally, at the end of my presentation, I will basically discuss some development strategy and policy recommendation, and in particular, probably the need now for many developing countries to ensure that part of their development policy, when it comes to international market, are still aligned or maybe need to be partly reconsidered in light of the changes that we have observed, both from the policy angle, but also the technological change that are taking place and that are reshaping and will continue to reshape the world economy in recent years. And linked to that is the question of how basically to ensure or to promote the creation of quality jobs, seeing that, for instance, manufacturing-led export, but also services-led export might not necessarily be sufficient to basically achieve the creation of enough quality job for all in the economy. And let's say, the change maybe among development economy thinkers that there is probably a growing need to consider more the non-tradable services sector. But I will come back to that towards the end of my presentation. So, quite a large program. I hope you stay with me and for the rest of the talk. So let's start now with the development in major international market. And what we could say is that the year 2024, if you look at the surface on international trade, international commodity market, capital flows to developing country, it gives a sense of a return to a rather satisfying situation, especially if we compare 2024 with what we have observed before 2023, for instance, 2022, where after the COVID roller coaster years, there were still, trade, for instance, was extremely subdued, especially manufacturing trade, but also capital flows to developing market were extremely weak. So initially, this year, if you open the newspaper, you will basically get some positive news from those areas. Now, as you can see, in fact, from my previous slide here, we labeled the second chapter of the TDR 2024 that deals with international market, the illusion of a rebound. Because, to be frank, we don't really believe that this assessment of a significant improvement in the external situation for developing country is really strong and in our view it might not necessarily last. So there is actually this apparent normalization, so to speak, mask in our view many fragilities. The first one is that the improvement is partial at best, and as I said before, is unlikely in our view to continue for too long in the future, and I will come back to that in a moment with more element. Also, as I said before, there are long-standing structural weaknesses that predates the COVID-19 shock and that still require lots of attention. One, I will come back to in more detail in the rest of my presentation, is actually this deterioration of in the distribution of the trade gains over the years. And a last element that also explains why we believe the current situation is far from being ideal is that, as you know, there are ongoing tectonic shifts, which are reshaping international trade. Lots of new policy that are emerging, sometimes completely, unilaterally, and that's obviously create more and more difficulties for policymakers, especially from developing countries, to navigate that changing landscape. So all that is to say that when it comes basically to the current period, there are very high uncertainties that are weighing on international market, and unfortunately, those immediate problems risk distracting policymakers from addressing the long-term challenge that are actually becoming more and more urgent. So more precisely, when we look at all these three broad international sectors, what are the key recent the central bank of developing countries? So if you look at basically that indicator, for the first time in 9 quarters, so at the beginning of the year, this indicator turned again positive. After it registered for 9 consecutive quarters a negative value. So that means that in aggregate, the resident units from developing country again became net borrower vis-à-vis the developed economies. Unlike in 2022 or 2023, when they were actually, and that's quite surprising, net creditor vis-à-vis the developed world. So in a sense, this this reversal of this negative trend earlier this year was rather a positive signal, partly because, and I will come back to that in a moment, several developing countries managed to tap again the international bond market after they were basically, de facto, almost excluded from those markets for 2 years. Now, turning to commodity market, we observe that international prices have also receded partly from their 2022 peaks, which follow basically the outbreak of the war in Ukraine. And that's a rather good news for lots of consumers, especially the poorer household in developing countries, whose purchasing power has often been extremely reduced because of price hikes. However, for many commodities, international prices remain pretty high by historical standard, and in aggregate, the broad aggregate for international commodity prices is still 20% higher than or above its 2019 level, so the pre-pandemic level. So that means that even though there has been a decrease, the price remain quite elevated. And also something that we observe is that very often this decline in international commodity prices have not necessarily translate into similar changes in local currency or in domestic market, mostly because quite a number of developing countries have seen significant currency depreciation in recent years, and that means that for ultimately, I mean, the consumer in those markets and the price they pay to get some basic commodity has actually not necessarily declined. Now, turning to international trade, the current estimate that we have now for 2024 point to a rebound of about 2 to 3% in real terms for both international trade in goods and services. So again, that's a rather positive news, because if you look at the figure of 2023, though it's not out completely, let's say, finalized at the moment among various international organizations, because we are still waiting for some data specifically in the area of trade and services. But last year, I mean, what we can say is that the evolution of growth of trade, in international in both goods and services was almost zero. And this year we expect 2 to 3%. So that's partly because manufacturing trade has rebounded. Actually, the year 2023 was very special in the sense that it was the first time, probably since the 80s, if not, I mean, the Second World War, that we had a contraction in real terms of manufacturing trade, while in fact the world economy was growing. So I don't know if you are familiar with this concept of elasticity of, for instance, international trade vis-a-vis the global economic activity, but that's basically compute what is the variation of international trade to the variation, I mean, the ratio of the variation of international trade vis-a-vis the variation of the world economy. And usually you have a positive figure there, meaning that when the world economy is growing, trade is growing. Not only you have a positive figure, but in the years before the global financial crisis in 2008, you usually have a figure or a ratio of about 2, meaning that trade was growing actually twice faster than the world economy. Then after the global financial crisis, that declined, and we had, I mean, some values around 1, meaning that global trade was actually growing more or less at a similar pace with the global economy. Actually, last year, what we had is that trade, the elasticity turned negative. So trade contracted, manufacturing trade contracted while the world economy was growing, and that's something that was unprecedented, at least as long as we had good data to compute those statistics. There were 2 years, 2009, 2020, where global trade turned negative, but at the same time, the world economy also contracted. But yeah, 2023, in a sense, was unprecedented in this context. And this year, there were some rebound of merchandise trade, though they were relatively weak. Now, yeah, as I said before, I mean, under the surface, there are, I mean, major fragilities and challenges for policymakers, particularly in developing countries, partly because there is very high uncertainties, and that's something that to keep in mind. So let's now focus a little bit more on one particular area of capital flows to developing country, which is basically relating to the debt and the public debt market. So as I said before, and you can see that from these charts, there was in 2024 here, you can see that, I mean, 2022 and 2023 on the chart on the left, if you look at the total issuance of bond by sovereign in the developing world, there was a significant contraction. during the pandemic years, and even before 2019, we were around, 120 billion per year of bond issuance, and then basically that was divided by two. There were only 60 billions of dollars of new bond issuance in 2022, and a similar figure for 2023. So now the figure here for 2024 is only going until August, but we know that actually the figure for 2024 will be significantly higher than the previous 2 years. So that's an indication that sovereigns in developing country have managed to access more easily the international bond market. Having said that, what you can see from the figure in the middle is that unfortunately the new bonds that are issued by those sovereigns come with a higher interest rate, and that's because we were evolving in a world with higher interest rate in the US, in Europe, and in most of the developed world. So yeah, to remain attractive, developing country had if they want to issue some bonds, they have to basically provide an interest rate which is also higher, and that basically raised concern for debt servicing issues in the years ahead. Also, when one area of concern is basically the number of countries that have managed to issue new bonds, and there we see that in 2024 we are still below what we used to observe, meaning that for quite a number of developing countries, actually, it remains very, very difficult to tap the international bond market. And trying to further, disentangle what's going on within developing country, for our analysis, we have basically split this large group of developing country within two sub-aggregates. One refers to the emerging markets economies, which are actually mostly upper middle income countries that have integrated into the international capital market since the 1980s. And then we have a second group, which are that we call frontier market economies, and those are mostly low and lower middle income countries that began to tap the international capital market after the global financial crisis of 2008. And usually the frontier market economy, they issue mostly speculative grade sovereign bonds with high yield for global investor, and they tend to register greater volatility in terms of their spread vis-a-vis the US treasuries. And that's mostly because you have quite a number of participants, like for instance, pension funds, who are precluded from investing in non-investment grade, for debt instruments. So ultimately, it's mostly like hedge funds that predominate basically the ownership of those security, and that's explained also partly why sometimes they have higher volatility when it comes to the evolution of their spread. And what we saw here is that right after the beginning of the pandemic, there was a very significant spike for the spread. So meaning basically on average, what are the return, and also how much sovereign must must pay when they issue, new bonds to the investor. So there was a significant spike in 2020, and then that has basically remained pretty elevated and at higher level than what we used to observe since basically 2012 until 2020. Again, after in 2022, there was a second episode of rising interest rate, and that has partly receded now, but still we remain, on average, the median for that group is still basically 500 basis points above the U.S. Treasuries, and that has some incidence and some negative effect for the fiscal space of this country, because that means that basically part of their expenditure, or a higher part of their expenditure, is devoted to debt servicing, and therefore cannot be used for more positive development project. I don't want to spend too much time on that, because I think that the time is already running quite fast. But if you are interested, there is a box that addressed that issue in more detail in the recent TDR. I think at this stage, the main area of concern that we have when it comes to public debt is this increased financing cost. Also, for lots of developing countries, particularly in Africa, difficulties to tap the international bond market, and linked to that, also we have observed that several countries have went already into default. And unfortunately, the current international initiative to promote an adequate debt default resolution have unfortunately, lag behind, and at the moment do not necessarily trigger a quick and an adequate resolution of those problems, which is, problematic for development in the long run. So in this context, UNCTAD is offering a set of transformational proposals along the 5 stages of the debt cycle. So if you are interested into that, I invite you to read the relevant section of the Trade and Development Report, because I think that's something to consider when it comes to improving the situation in terms of debt vulnerabilities for developing countries. Now, I'm moving now to commodities market to say a few words in that area. In UNCTAD, we have an entire unit dealing with this question. So again, if you don't expect from me that I will address every particular market, because again, talking about commodities in general might not necessarily be adequate, because for some country like cocoa exporter, they might face a complete different evolution than coffee or tea or rice exporter and so on. But still, when it comes to the big pictures, what we can say is that, and as you can see here from the chart on the left, commodity prices until basically 2020 were rather constant or flat in terms of their evolution, and then there was a significant increase and a peak basically in the course of 2022 with the outbreak of the war in Ukraine. And then as things basically get normalized a little bit, at least on some of the key commodity market, the price basically receded. Now, at the moment, we are it has plateaued at a level which is, as I said before, still, 20% higher than what it used to be. And that not only because of the impact of the decrease of the fuel prices, because you can see also the index that exclude that category in yellow here is also significantly higher than what it used to be. Now, on top of those evolution, when it comes to minerals and metal, we have seen very significant volatility amid intensifying geostrategic competition. And when it comes to food and fertilizer, which is the charts on the right, the two charts on the right, sorry, which are pivotal for several key reasons, such as food security, inflation, but also agricultural sustainability, trade balances for many developing countries, and also obviously for trade, for political stability. The good news is that apart from rice, but for the key staples such as maize and wheat, that has partly, decreased. But as I said before, that doesn't necessarily mean that this evolution at the international level have always translated into a significant decrease of the domestic prices observed in local market. Now, how much time do I have?
You're still good on time. You have close to an hour.
Okay. So
We can do 40 minutes.
yeah. Okay, no, but that should be fine. So now turning to international trade. As I said before, we have seen, some impetus in early 2024. Although, there are some divergence across a region. If we focus, for instance, on developed or more advanced economies, what we can see here, so you have the export on the left and the import on the right, and in particular, you can look at the light blue light that represent the United Kingdom, of the gray line that represent the euro area. We have seen that so for Europe, which is a key player in international trade, the situation has basically not been extremely good. We have seen a significant decline in real terms of the export over the last, let's say, 24 months. And when it comes to their revenue in euro, so they were still, 3% lower during the first quarter of this year compared to the year before, even though there has been a significant inflation during that period. So in real terms, actually, the decline was actually more important. And if we look at other region, and that's a figure that takes into account most of the developing world, so to speak, or at least it's there we can observe that Asia, and particularly East Asia and China, when it comes to export, have performed relatively well in recent over the last 2 years. However, if you look at the import of China, which is the chart on the right, you can see that the blue line here has rather stagnated since 2021 or 2022, and that's obviously might be an area of concern from other developing country exporter, as China has become now the most, or at least a very important trade partner. So when it comes to the external demand provided by China to other developing countries, partly for the reason that Cam mentioned before, the deceleration in the construction sector and so on, that has a strong implication for the prospect of the other developing country exporter to this economy. Now, coming back to that, if we look at a more aggregate picture, we can also see that so here we have quarterly data. So as I mentioned before, I mean, trade picked up earlier this year, but actually part of this rebound was partly driven by front-loading orders from China as importer, mostly in the US, but not only, expected, I mean, further tariff hikes over 2024. And that's actually something that is currently probably repeating itself at the moment. Is that because you have quite a number of people expect that there might be further tariff hikes down the road, they are now taking advantage of the current situation to import quite a lot before that will basically kick in. But ultimately, that doesn't mean that trade is necessarily extremely robust and growing fast in the longer course. Other thing we can mention here is that, we have observed in terms of trade policy quite a number of new protectionist action, especially but not only vis-à-vis the China. And that's not only restricted to OECD economy. You have quite a number of developing countries who have also, taken measure to sometimes, limit the export from China. And again, though we sometimes understand the need to implement those measures, we argue that there is ideally, a need to better implement those measures maybe in a more multilateral way, because otherwise there is always the risk of retaliation, and that may ultimately affect everyone. But I know it's not an easy something easy to do at the moment. Now, one last thing I want you to keep in mind from that chart is the evolution of trade in services, which over the years have proved, over the recent years have proved much more dynamic than merchandise trade, and that's something I will come back in a minute. Okay, so that's for the. So what we lost. Okay. Sorry for that. I got confused with my notes, but no, that's okay. So, turning to commercial services, it has attracted, more and more attention over the years, partly because manufacturing trade has been rather subdued, and by contrast, trade in services has been relatively, has been first extremely resilient during the COVID 2020 crisis, apart from some specific segments such as travel and transport, which were hit for obvious reasons. But if you look at all the other component of commercial services, it actually didn't decline in 2020. And since then, it has grown at a pretty fast pace. So here we consider a slightly longer time span, and what we can say is that we expect in the long run, trade and services to continue expanding at a faster pace than manufacturing trade. Yet, for this year in particular, we have seen that travel has continued to rebound significantly. And here we don't have the data yet for 2024, but when it comes to transport, there is also a significant rebound this year. And unfortunately, those components of trade and services, the one that have registered, the faster growth this year, which is transport and tourism, are also sectors that are quite high in terms of carbon emission, and that's something that we should also take into account when we look at those evolution, because sometimes and in particular when it comes to transport, this year there was some significant increase if you look at transport revenue, but that's actually because of what happened in the Red Sea and the need for lots of shipping companies to basically reroute their vessels, and ultimately, that means for everyone, but probably the shipping company, higher expenditure, but ultimately this strong growth that we observed this year is not benefiting many people except from those shipping companies. So that's something to keep in mind, and sometimes higher figure here doesn't necessarily mean an improved situation. Now, let me now turn to more long-term and issues that relates to trade. After I've reviewed basically the short-term trend at the beginning of my presentation, because there are many areas of concern that predates the pandemic and that still require, in our view, an urgent attention by policymakers if we want to make sure that trade plays a pro-developmental role. And that's basically drawing mostly from a chapter we wrote last year for the 2023 Trade and Development Report. So the long-standing relating to this concern is the first thing I want to discuss with you in more detail is the unequal distribution of trade gains that is apparent in both developed and developing countries. Because in all likelihood, it seems that trade-induced income inequality have deteriorated further during the pandemic years. And as I will further explain in a few slides, I will explain, how we have come to this finding. And lastly, also an important things to be aware are the tectonic shifts that are taking place because these risks are expected, at least under the current configuration, to hamper the prospect for structural transformation in developing countries. So let's now focus in more detail about the distribution of trade gains. Obviously, there are many motivations and many reasons that could be expressed to justify the need to look at this topic. I would say one of the key reasons for me is to be confident, as a policymaker, that the medicine, which is sometimes viewed as more trade, is ultimately, beneficial to the majority of people, because if it's not the automatic outcome provided by the market forces, trade liberalization has to be basically complemented by other policy to make sure that ultimately it benefits, the majority of the people. And obviously, for researchers, assessing the distributional effect of trade, both within and also across a country, is often a very challenging exercise because the data on inequality, when they exist and are publicly available, they usually come with a lag of a couple of years. So if you want to basically intervene as soon as possible, you have to rely on some proxies in order to understand or to try to understand what's going on at the moment. And in this area, we have done, two types of analysis. The first one was to look at the evolution of the concentration of export among a firm within developing country to get a sense of whether or not trade has become more or less concentrated, with the idea that if it's more concentrated, maybe it will have a negative impact on inequality when it comes to the distribution of trade gains. And the second exercise we have done is to look at the evolution of labor and capital income shares. That's something that Cameron already discussed before. So when we look at those functional income distribution between labor and income, to try to better understand how whether trade have an effect on those distribution, and in particular, within capital income, we have disentangled that between the income or the profit of the top 2,000 largest firms in the world versus, the rest of the capital income that is accrued to the rest of the entrepreneur and capital owner in the world. And as you will see, there are some interesting findings that came out from that analysis. And in our assessment was that, in fact, during the COVID years, which were where trade, played an important role, because it was actually from the initial shock, it was actually booming in 2021 and 2022 when it comes to merchandise trade. Then that means that probably the gain or the distribution of the trade gain have been quite asymmetric. Now, that's, I think, important because as we are now facing more and more challenges when it comes to fiscal adjustment, having those indicators in mind, might be important in order to assign or to share more equally or in a fair way, let's say, the burden of those fiscal adjustments that are ongoing. Okay, so let's now focus on the first indicator, which is basically about the evolution of export concentration. And we know that export concentration is always quite high, no matter if you are in a developing country or a developed one, usually because we know that trade is ultimately very often quite an area for very large firm. So it's a sector. Trade is always, and export in general are always extremely concentrated. And here we had the opportunity to use an early release of a database developed by some World Bank economists that's called the Export Dynamic Database. That basically track in a number of developing countries those export concentration. And what we observe on the left figure is the evolution of the export concentration for the top 1% exporting firm within each country. And as you can see, okay, it's not completely uniform, but if you look actually at the number, what you observe is that among the 27 countries for which we have sufficient data, in almost half of the cases, the export concentration of the aggregated share of the largest top 1% of exporting firm have actually increased by an additional 2 percentage points. For about 1/4 of the sample, it didn't change that much, meaning that there was no significant decline or increase. And then for only 1/4 of the firm, there was actually a decline of the export concentration. So in general, there was more like a kind of tendency towards increased export concentration, at least in the developing country we were able to survey. And now, when it comes to the very let's say top right of the distribution, if you look at actually not this time not the percentage, the 1% firm, but the biggest firm, the biggest exporting firm in the country, or the 5 or 10 largest exporter, you can see that in most of those countries, a large part of the export revenue actually accrue to a very limited number of firms. And very often, if you look at the top 10 firms, I mean, they will basically, it's common to see that they will capture 50% of the export revenue. So again, I mean, that basically raise concern in terms of sometimes market control and the distribution of gain from trade, which I will further address in my next slide. So here it's basically the second indicator that we have developed to better understand how what has been somehow the evolution of the distribution of economic activities, and in particular what is the role of the largest 2,000 multinational enterprise in the world in that area. That's an exercise we started already in 2018, but we saw that after the pandemic years, it was interesting to repeat that exercise to see how those indicators have evolved over time. So the idea is the following: you have on the left figure the distribution of income of the world economic activity that is split in 3 parts. You have the part that accrue to basically the labor, so that Cam described before, which is in blue. Then, and that partly truncated because it goes actually from 0 to around like 50%. And then you have the part of capital income that goes to all the capital owner except for the profit of the top 2,000 MNEs. And then in the middle, in orange, you have basically the net income of the top 2,000 MNEs. So in other words, basically the share of their profit vis-à-vis the world GDP. And as you can see, I mean, that orange area has actually grown over time. And most likely during the pandemic years, it has continued, except for what Cam mentioned before, a small contraction in 2020, but that was only temporary. And after that, it kept on increasing. In the right-hand side, on the right figure, you have actually the evolution, the relative evolution of each component. And what is interesting to see here is that actually the orange line almost mirrors the blue line, meaning that the decrease of the labor share at the world level is actually reflect the increase of the profit of those largest 2,000 MNEs that we observe and we survey in our database. So that's basically give a sense about the driving forces that are affecting the functional income distribution at the world level. And obviously, I mean, those 2,000 largest MNEs, they are not only, I mean, obviously getting their revenue from international trade, but they are major player in international trade. And that's why we believe that analysis is important when it comes to the distribution of the trade gains. Now, after talking about this first area of the distributional gains of trade, let me just quickly review with you, but I think you are familiar with that, so maybe I won't devote that much time about this slide, which is basically just to emphasize that the international landscape is changing, and it's changing fast because partly of the ongoing, I mean, trade dispute between China and the United States, something that might unfortunately have even more prominence in the near future. We have also seen, I mean, quite a tendency towards, I mean, the more control when it comes to export. Sometimes it's for good reason, because some developing countries want to have a better control of their resources and want to add more value added in their economies. But sometimes it's also to constrain, I mean, geopolitical rivals, and that's create, obviously, I mean, might create further tension and ultimately the risk of a protectionist spiral. And we have also witnessed a growing rise of subsidies of all kind, not only but mostly by major developed countries, and partly, I mean, that's to foster the green transition. So we were somehow delighted that countries like the US, the European Union have somehow embraced more industrial policy, because that's a topic and a recommendation that UNCTAD has basically advocate for decades. But sometimes, and unfortunately, I mean, the way sometimes those industrial policy were implemented didn't consider, I mean, carefully the needs of developed country. And as you probably all know and all face in your daily activity, there are quite a number of concerns when it comes to the prospect of exporter of developing country who rely on the developed market. But I think let me now rather move to the last part of my presentation that relates with the growing consensus among development economists, which refer to the need for developing country policymakers to look beyond manufacturing-led export in an era of subdued merchandise trade and rapid digital progress, in order to basically enable the creation of quality jobs in the services sectors, but including, I will argue, in the non-tradable services. So I think, one takeaway of the first part of my presentation is that a strong revival of world trade is rather unlikely in the coming years, and in particular when it comes to manufacturing export. And this slower trade cast, in fact, doubt about the development model relying on manufacturing-led export, which has supported successfully development in part of the developing world in the last decades. And another concern we have in this area, and that relates to basically the comparative advantage of cheaper and often less skilled labor, which are relatively abundant in developing country. These characteristics are necessarily no longer aligned now with the reliance of modern manufacturing on skill and capital-intensive production. So in this context, you could think that an alternative candidate for development strategy will be to consider more, trade in services. But what we argue in the report is that trade in services, most of these sectors alone also face several limitations and can, scarcely be expected to become a realistic alternative to manufacturing-led development. So a key limitation for trade in services to compensate for the diminishing role that manufacturing could play for development is the inability of this sector to fulfill actually the dual mandate of, on one hand, enhancing productivity gains, and at the same time creating many jobs for unskilled workers. So when you look at trade, at tradable services, there are basically two types of service, two types of trading services. You have one that is relatively, dynamic, such as banking, information technology, business process outsourcing, and so on. But that provide, limited scope to generate widespread employment for unskilled workers, for actually the same reason that manufacturing nowadays is unable to generate sufficient jobs for the unskilled labor force. So in short, these sectors are now rely more and more on on high-level skills, and automated process. So they are not they are not able to generate widespread employment. And then you have other types of tradable services, such as tourism, construction, where actually you have probably more scope to create employment, but in those areas, achieving meaningful economies of scales and significant productivity enhancement is much more limited. Although sometimes, the ability of those sectors to create backward and forward linkages with the rest of the economy is also more limited. And finally, and that's related to the question that we have before from our Brazilian colleague, you have sectors like information and communication technology that are rather booming when it comes to trade in services, but usually they remain, primarily dominated by a limited number of large firms in the developed world. So more broadly, those asymmetry in export among the country group, together with the issue of market concentration, explain why it seems difficult to envisage that international services could really supersede what manufacturing-led development successfully achieved in the past in some part of the developing world. So in light of these elements, the deductive reasoning will suggest that there is no other solution than relying more on services in some non-tradable sectors. So obviously the idea is not to fully abandon manufacturing-led development, or also to ignore the benefits that trade in services could bring. But when it comes to setting, the right balance between all these sectors and to decide how to allocate limited public resources and to basically decide which sector might be more might benefit more development in the future, it might not be a bad idea to maybe dedicate more resources to the non-tradable services sector. And that's, in fact, an idea that was also brought forward earlier this year by two prominent development economists, Danny Rodrigue and Joseph Stiglitz. And they argue that probably there is a need for now more inclusive and equitable growth strategy, even though in the future growth might be slightly lower. So the core idea is to deliver direct income gains for the poorer segment of the society through better jobs and thus ideally, build a middle class rather than necessarily wait for a kind of trickle down from the export champions and the largest firms. So there are quite a number of new studies who have been advancing a vision for services-led economic development in more practical terms, even though I must acknowledge that at this stage there is still a long way to go before we understand very well how to raise productivity in labor-absorbing services. But just to give you some idea, and you can find more about that in our trade and development report, there are quite a number of initiatives that have taken place in various countries, and you have them described here in this table, that basically express how or illustrate, part of what the author refers as a three-pronged strategy that could focus on one hand on encouraging lower skill job creation by largest firms in the non-tradable services, but also providing public input and access to productivity enhancing investment for smaller enterprise as part of the industrial policy, understood, let's say, as something broader than just for the manufacturing sector. And then finally, also the need to invest in technology to complement rather than replace the low-skilled worker in services sector in order to also, boost their productivity. So lastly, we know that embarking as policymaker will embark on those challenging journey of critically reviewing, assessing, and recalibrating their development pathway for the decades to come. The discussion above can provide, I hope, some valuable food for thought. And I think at this juncture, it is worth stressing that perhaps the most cautious and promising approach to implementing modern industrial policy involves basically two aspects in parallel. The first one is to address some of the identified problems, which has always been the motto and the bread of industrial policy, but at the same time trying to minimize the adverse effect on international cooperation and multilateralism. We are aware that this new odyssey won't be easy, as was the case for previous attempts to harness the best of globalization. But boosting productivity in services, because boosting productivity in services, is known for being complicated. Yet, attempt to provide good job for most citizens without greater consideration of non-tradable services seems increasingly impossible at the current juncture. So with this conclusion, I thank you very much for your attention, and I'm here for questions or comment, and I'm happy also to hear from your national experience if what we have basically pushed forward in this TDR resonate or echo with what you are observing in your economy. Thank you.